SpaceX priced the biggest IPO in history at $135 a share, 85.7 billion raised, around 1.77 trillion. Weeks later, the stock trades nearing 124, a market cap around 1.63 trillion, below the IPO print. And the story still propping up the premium is a data center that today cannot cool its own GPUs the way Wall Street imagines. If you only remember the ticker and the hype, you will miss the real question. Is orbital compute a breakthrough or a valuation trap wearing a spacesuit? On a slide deck, orbital compute is almost unfair. Continuous solar power for large stretches of the orbit. No multi-year municipal power fights, no river permits for cooling towers, no neighbors fighting a humming warehouse at the edge of town. You put silicon above the atmosphere, beam results down, and let gravity do the rest of the marketing. That pitch is emotionally perfect, which is exactly why it is dangerous. Perfect pitches hide the physics bill until after the capital is already moved. Later level away. Let's name the actual bet carefully. Not Starlink broadband, not Mars colonies, not every Elon narrative at once. The claim is this: put AI compute in orbit, solar-powered satellite data centers, and you escape Earth's power grid, cooling water, and real estate bottlenecks. That is the orbital data center thesis. Everything else in this video is a stress test of that single claim. If the claim fails, launch and connectivity can still be valuable. But the multi-trillion AI in space premium needs this thesis to clear physics and cost, not just press releases. Before we drown in ticker symbols, hold 3 gates. First, physics has to work at rack scale. Heat rejection, useful GPU clocks, and interconnect that is not pure fantasy. Second, launch cost has to collapse by roughly an order of magnitude, towards something like $200 a kilogram, not stay near $3,600. Third, customers have to pay for orbital capacity, not just for temporary ground GPUs with a SpaceX logo on the invoice. Miss one gate and the thesis breaks. Pass all 3 and the bull case becomes interesting. Most debates fail because people argue gate 3 while pretending gate 1 is already solved. Here's the first physical wall. On Earth, data centers dump heat into air and water. Fans, chillers, cooling towers, the whole industrial plumbing of convection. In orbit, you are in vacuum. There is no air to blow across a heat sink, no river to heat, no evaporative cooling tower on the roof. Heat only leaves by radiation. That is not a slogan from a skeptic blog. It is a hard thermodynamic boundary. Every kilowatt your chips turn into heat must eventually leave as infrared from a surface facing cold space. If that surface is too small, too hot, or pointed wrong, your expensive silicon throttles or dies. Radiation cooling needs area. Big, heavy radiator surfaces. Point them toward cold sky, manage solar load when the sun hits, survive eclipses when the thermal environment changes, and still keep chips inside a narrow temperature band. Every square meter of radiator is a mass you launch, structure you build, and failure modes you inherit. Micrometeoroids, deployment jams, degraded coatings, pointing errors, they all become thermal risk. Cooling stops being a facilities expense you hire a contractor for. It becomes a spacecraft design problem that rides on every mission success probability you already struggle to price. Researchers ran multi-physics simulations of orbital GPU thermal behavior, archive paper 2606.05741, presented around ISLPD 2026. In a 200-watt heat rejection case, both the GPU core and high bandwidth memory pushed past safe limits. To stay alive, the chip needs aggressive throttling, on the order of a 50% or greater clock cut when logic exceeds about 95 degrees Celsius. Read that again slowly. Half the clocks. That is not a rounding error on performance per watt. That is a different product. If your marketing assumes full terrestrial GPU throughput in orbit, the paper is a direct contradiction, not a footnote. A fair rebuttal. Spacecraft already use heat pipes, pumped fluid loops, and two-phase systems. True, those technologies are mature and impressive. They move heat from the chip package to the radiator. They do not invent a cold river in vacuum. They still end at radiation, so active thermal control can reshape the problem. Smoother temperature, better spreading, fewer hotspots. It does not delete the area, mass, and reliability tax of rejecting kilowatts to space. Anyone who says we have heat pipes, so vacuum is fine, is confusing transport with rejection. Transport is solved in many spacecraft. Rejection at megawatt AI scale is the open war. Second technical wall, workload fit. Another 2026 archive paper, 2606.13086, is blunt. Orbital data centers are generally a poor place to train brand new large models from scratch. Why? Limited onboard compute density under thermal and power constraints, and the brutal cost of shipping petabyte-scale training sets up and down. Frontier trading is not just more GPUs. It is dense interconnect, synchronized steps, and rivers of data. Orbit breaks the warehouse assumption. If your investment thesis needs space to train the next frontier model from zero, the literature is already waving a red flag. The same research points to more plausible jobs. Serve pre-trained models near users or sensors. Push incremental updates. Run fine-tunes. Shuttle gradients and model shards when latency budgets allow. In other words, inference and light adaptation, not the full industrial training cluster that burns megawatts on Earth with dense NVLink fabrics. That distinction matters for valuation. Inference is a real market, but it is not the same narrative as we will train AGI in LEO. When you hear orbital compute, ask which workload. The honest answer is usually narrower than the pitch deck. Dense training wants nanosecond-class GPU fabrics and predictable fat pipes between racks. Orbit gives you laser crosslinks, changing geometry, Earth occlusion, and long-haul downlinks. Data parallel jobs can tolerate seconds. Pipeline parallel can tolerate milliseconds in some designs. Full-scale model training still wants a warehouse of copper and silicon in one building, not a constellation trying to pretend it is one motherboard. This is not anti-space. It is anti-category error. Starlink-class links can be extraordinary for connectivity. They are still not a substitute for a carefully engineered training pod on a concrete slab with short cable. Now, the money. Engineer Andrew McCallup's public cost framing puts a 1 gigawatt orbital data center around $42.4 billion. A comparable ground facility sits roughly $14 to $16 billion. Call it nearly 3 times the capital for the same headline capacity. Before you price risk, schedule slip, insurance, on-orbit failure, or the fact that a dead satellite is not a repairable row in a warehouse. 3 times is the optimistic framing, if the model inputs hold. If launch stays expensive or Radiators eat mass budget, the multiple gets uglier. Capital markets can fund ugly multiples. They should not call them bargains. Energy economics look worse. Using Starlink-class satellite assumptions, orbital energy cost lands near $14,700 per kilowatt per year. Ground data center energy is often modeled in the $570 to $3,000 range, depending on region and power contracts. That is 5 to 26 times more expensive energy service. The silent killer of space is free power marketing. Sunlight is free. Delivered, reliable, thermally usable kilowatts on orbit are not free. Confusing photons with power plant economics is how smart people buy dumb multiples. The arithmetic is not mystical. Take a Starlink V2 mini-class assumption. About 575 kilograms, roughly 28 kilowatts, 5-year life, at $3,600 per kilogram to orbit. Multiply mass by launch price, divide by power in lifetime, and you land near $14,700 per kilowatt year. Change any input, and the output moves. Longer life helps. Heavier radiators hurt. Cheaper launch helps a lot. The point is not that one satellite model is destiny. The point is that the scary chart has a skeleton you can audit. Mass, dollars per kilo, watts, and years. Now the hinge of the entire bull case. If launch falls from about $3,600 a kilogram to $200 a kilogram, roughly an 18 times improvement, that same satellite energy math drops toward $810 per kilowatt year. Suddenly, you are inside the ground cost band. Orbital compute stops looking insane if, and only if, that launch price arrives with enough cadence and reliability to matter. Everything bullish about space AI compute is, at root, a derivative of Starship-class industrialization. Without that hinge, you are buying poetry. Google's Project Suncatcher white paper sketches a path where $200 a kilogram might become plausible in the mid-2030s, if Starship-class vehicles fly on the order of 180 times a year. That is a serious, specific assumption, not a vibe. SpaceX's own S1 disclosures, as reported around the IPO, acknowledge uncertainty in the Starship reuse path. The spreadsheet is clean. The flight rate is not. Mid-2030s is also not next quarter earnings. If your valuation needs the hinge in 2027, you are early by a calendar, not by a weekend. Here's where many investors get misled. SpaceX has signed large compute offtake-style deals, Google around $920 million a month, Anthropic around $1.25 billion a month, Reflection AI around $150 million a month. Those are real dollars and real demand for GPUs. They are also, as disclosed, short-term bridge capacity on ground Colossus clusters in places like Memphis, not orbital racks beaming tokens from low Earth orbit. If you count ground bridge revenue as proof of orbital product-market fit, you are double-counting a different business. Cash is cash. Thesis proof is not. Read the fine print energy of these deals. Reporting around the IPO emphasizes short tenors and 90-day exit style clauses. That is not a 10-year hyperscale lease with sticky renewals. It is flexible bridge capacity while everyone races for GPUs and power on Earth. Great for filling a building and printing near-term revenue. Factual is proof that the world has pre-ordered 1 million orbital servers. When capacity elsewhere appears, exit clauses matter. Treat bridge of offtake as evidence of AI scarcity today, not as a locked-in order book for space. In early 2026, reporting described a SpaceX filing seeking authority for as many as 1 million solar-powered satellite data centers, framed as an efficient way to meet exploding AI compute demand. Treat that number as a regulatory opening bid, not a launch schedule. Historically, the FCC has approved far fewer satellites than operators request. Prior Starlink rounds saw roughly 7,500 approved against much larger asks. Spectrum, debris, and coordination politics do not vanish because the application uses the word AI. 1 million satbacks is theater and negotiation. Permission is a different verb. Zoom out to the financials disclosed around listing. 2025 net loss, about $4.9 billion, on more than $18 billion of revenue. Cumulative losses north of $37 billion across the journey. That does not make SpaceX fake. Building reusable launch and a global constellation is historically expensive. It does mean the equity story is still a growth and optionality story, not a mature, high-margin utility already printing orbital compute cash. Pricing it like a finished AI power plant while the P&L still looks like a moonshot is the core tension. After its IPO, SpaceX briefly traded like a top 10 global megacap, around $2.16 trillion in the late June snapshot. Since then, the stock has fallen below the IPO print, cutting the market cap to about $1.63 trillion by mid-July. The narrative premium that briefly put SpaceX alongside NVIDIA and Apple has partly evaporated. The market is not pricing last year's EBITDA. It was pricing a stack of future monopolies. When the stock falls, it is a reminder that narrative multiples are only as strong as the evidence supporting them. Put the paradox on one board. Cumulative losses. Bridge ground contracts with exits. Orbital capex near 3 times ground in the 1 gigawatt model. Energy potentially 5 to 26 times ground until launch collapses. Starship reuse still a disclosed uncertainty. The equity price can still be right if the future's clear. If Starship industrializes, if thermal scales, if demand pays for orbit. But priced as inevitable and proven as inevitable are different sentences. Your job as an investor is to know which sentence you are paying for. Stillman the bulls without sarcasm. If Starship truly industrializes launch, if terrestrial power and permitting stay broken for years, if laser links and radiators scale, and if SpaceX's vertical stack, rockets, satellites, spectrum relationships, and 8 of cactic compounds, then orbital compute could become a third act after launch and connectivity. Optionalities can be worth a fortune before they are cash flows. Public markets have paid for that before in energy, biotech, and platform tech. The bull case is a stack of hard optionalities, not one gadget demo. Still him the bears without sneering. Thermal rejection never gets cheap at megawatt scale. Starship cadence slips into the late 30s. Hyperscalers keep building ground campuses wherever power appears. Nuclear deals, stranded gas, new substations. Laser bandwidth and on-orbit serviceability disappoint. Regulators never bless mega-constellation compute at the density the pitch needs. In that world, orbital AI becomes a beautiful demo program, and a dangerous narrative multiple glued onto a real launch company. The failure mode is not zero revenue. It is permanent demo plus permanent premium. If you are evaluating the story as an investor, not as a fan, keep a checklist. 1. Independent evidence that launch is marching toward $200 a kilogram, not just promised on keynotes. 2. Multi-megawatt thermal demos with GPUs at useful clocks, not lab watts. 3. Multi-year offtake without 90-day trapdoors, ideally for capacity that is actually orbital. 4. Real spectrum and constellation authorizations, not press release asks. 5. A service model that survives satellite replacement cycles and insurance realities. Fans skip the list. Investors date the list. The research pack ends with open questions for a reason. Can Starship hit the cost curve on time? Will regulators ever approve compute mega-constellations at meaningful scale? Do bridge GPU contracts convert into durable demand, or churn when someone else's cluster opens? And can radiator architectures escape the 50% throttle regime without launching a second spacecraft just to cool the first? These are not gotchas. They are the actual decision variables. Until they resolve, certainty is a costume. If you take one sentence from this entire video, take this. The space data center is not free compute. It is physics first, launch cost second, marketing third. Reverse that order and you will confuse a pitch deck with a power plant. You will also confuse ground bridge revenue with orbital product market fit. Keep the order straight and you can still be bullish. Just honestly bullish. Remember 3 things. First, separate ground GPU bridge revenue from the orbital data center thesis. They are not the same asset. Second, price the thermal wall and the launch cost wall before you price the narrative. Third, treat mid-2030s optionality as optionality, not as cash already in the bank. The opportunity is real as engineering. The trap is paying inevitability prices for conditional physics. Watch the 5 checklist items. Update your view when evidence moves. And just to be clear, this is education, not financial advice.